The 30 down rule. Hi, I'm Jason Kelly with the Kelly Letter. Recently I asked for questions from subscribers and many came in about the 30 down rule. So I'd like to take about 5 minutes to discuss what it is and why we use it and some changes that have taken place recently. The 30 down rule is simple. It specifies for the 3% signal plan that if the S&P 500 as gauged by SPY, the ETF SPY, declines 30% from its quarterly closing high of the past 2 years, then the plan locks in place for the following 4 quarterly sell signals or 2 years, whichever comes first. The quarterly sell signals might not come back to back. And so the idea with this is that the plan locks into stocks for the big recovery that usually happens early on after a big decline like that. It's very clearly specified to the S&P 500, not a different index. When that big index goes down 30% from its quarterly closing high, historically it's been followed by a nice sharp early padded recovery, and that's what the plans are trying to lock in and take care of. Otherwise, what would happen is that as the market rose up, the plan would keep taking money out of stocks each quarter as it hit big sell signals. And if it does hit a buy signal and there's more buying power, then it will go ahead and take care of that and actually buy more of the stock fund. But if there's a sell signal, it will ignore 4 of those actually in the next 2 years in order to stay in for that big recovery. In the initial permutations of the 6 SIG plan and the 9 SIG plan, which use 2x leverage and 3x leverage respectively, I also used a 4 sell skip version of the 30 down rule. And we entered that 4 sell skip version of the 30 down rule in January 2019. That was after the fourth quarter 2018 crash. I decided after watching people's behavior through that time period, because we had so much money in the stock funds and we were locked in and couldn't sell to create more buying power, I noticed people getting worried, misbehaving, so to speak, as far as the plans go. And I decided after looking back at my research that even though historically the 4 sell skip rule does better with the plans, people are not robots. And I think a 1 sell skip rule is better for them. That's what I concluded. And last autumn, I announced that. So for 6 SIG and 9 SIG, the 30 down rule works the same way, except that it skips only 1 sell signal in the next 2 years. And presumably it comes fairly quickly after that big decline. But not necessarily. Anyway, it skips just 1 sell signal, not 4. And that's only for the 6 SIG and 9 SIG plans. All right, well, what happens at the end of the quarter when we come out of the 30 down rule? This is also part of the original planning of it, and it hasn't changed in the change of the 30 down rule in the 6 SIG and 9 SIG plans. It's simply that after we skip the second sell signal, the following selling quarter is where we rebalance back to the base reset allocation. Now, these terms might seem arcane, hard to follow, but they're really not. Every Sunday letter shows you the base reset allocation of all the plans, and easy to remember. 80-20 stocks bonds for 3 SIG, 60-40 stocks bonds for 6 SIG and 9 SIG. So 1 quarter after the final skipped sell signal, in all cases, I need to phrase this carefully. In the next quarterly sell signal, after the final skipped sell signal, in all cases, we reset back to that base reset allocation. And that's in fact why it's called the base reset allocation, because you reset back to the base of the plan. And then it starts deviating from it right away from there based on price movement, but that's what it base resets back to. Now people wonder, why is 3 SIG not in a 30 down rule now when 6 SIG and 9 SIG are? Because 3 SIG uses the SPY ETF for the S&P 500, but the 6 SIG and 9 SIG plans use their stock funds specifically. So MVV for 6 SIG and TQQQ for 9 SIG. Those went into their 30 down rules in January of 2019. And they went into them again this last quarter. So now we have both versions of the rules running concurrently in the 6 SIG and 9 SIG plans. But in 3 SIG, we never triggered the rule. It's that simple. We'll just go back through the numbers. SPY's quarterly closing high over the past 2 years was 321.86 last December 31st. So minus 30% gets us to 225.30. It ended last quarter at 257.75. There's the answer. That's just how the rule works. People say, yes, but it went below that during the quarter. Doesn't matter. Pay close attention to the rule. When the quarterly closing price is 30% or more below the quarterly closing high of the past 2 years, that's when the rule is triggered. It wasn't triggered, so we didn't do it. So 3 sig is not in the 30 down rule. 6 and 9 sig are. It's possible 3 sig could go into it this quarter. We'll just see what SPY ends up doing. But I caution you against thinking, well, this is a mistake to have 2 of the 3 plans in it and one of them to not be in it. Not really. The leverage plans can go into that rule more easily, and that's another reason why I wanted to change it from 4 skipped sell signals to just 1 skipped sell signal, because of the higher frequency of entering the plan. And the other one is just that to lock in for a 4 sell skip signal requires a really dramatic drop. And to require it to happen at quarter's end means that it was persistent. Probably it's possible that it could just be coincided with the end of the quarter, but it probably means it's persistent, and we are justified in the high odds of recovery going all into the 3 sig plan. That should do it. I hope you better understand the 30 down rule and you are ready to keep following it in the Kelly Letter.